Welcome back. Today is March 30th, 2026, and if you're holding Micron stock, today was a rough ride. The stock plunged 9.88% during regular trading, closing at $321.80. That wiped out billions in market cap in a single session. So what just happened? The main trigger appears to be Google's new AI algorithm called TurboQuant, a memory compression technology that claims it can reduce the RAM required for large language models by up to 6 times. For a company like Micron that sells memory, hearing efficiency can sound like lower demand. So the big question is this a real threat or just a massive overreaction? Let's start with why the stock dropped so hard. First, there's a fear factor. Investors are worried that if AI models suddenly need 60 to 80% less memory, demand for high bandwidth memory, or HBM, could slow down. Second, recent performance played a role. Even after today's drop, Micron had been up more than 40% year to date before this week. It has been acting like a pure AI infrastructure stock, moving closely with names like NVIDIA, which means also more sensitive to AI-related headlines. Third, profit-taking. After a roughly 300% rally over the past year, a lot of institutional investors were simply waiting for a reason to sell and lock in gains. TurboQuant gave them that excuse. Now, if you're new to Micron, let's quickly break down what the company actually does. This isn't just about USB drives anymore. Micron's business is built on 2 main pillars. The first is DRAM, which makes up about 70 to 75% of revenue. This is a short-term memory used in servers, GPUs, and smartphones. The star product here is high-bandwidth memory, including HBM4, which is now being shipped for next-generation AI platforms. The second is NAND flash, which is long-term storage used in SSDs. Micron is pushing forward with its latest generation NAND, which is critical for massive AI training clusters. In short, Micron has evolved from a cyclical commodity company into a core part of the AI infrastructure stack. Now, let's talk about what Wall Street thinks. Despite today's sharp drop, analysts are still largely bullish. The consensus rating remains a strong buy. The average price target is around $547 over the next 12 months. On the high end, some bullish analysts are calling for targets as high as $1,000, driven by the belief that the AI supercycle could last through 2027. On the low end, more conservative estimates sit near $100, reflecting concerns about a boom and bust cycle. So what about valuation? At around $320, is Micron expensive? The trailing price-to-earnings ratio is roughly 16.6 to 16.9 times. That's slightly above its historical average, but significantly lower than its peak in 2025. Bulls argue that this doesn't fully reflect future earnings growth. Looking ahead, projected earnings per share could reach between $35 and $48 by 2027. If accurate, the current valuation could be considered cheap relative to growth. Many analysts believe that if AI demand is truly structural and long-term, then a mid-teens multiple for a company growing this fast could be a bargain. Now, let's go deeper into the real concern, TurboQuant itself. To understand why this matters, you need to understand something called a memory wall. In AI systems, memory has been one of the biggest bottlenecks. Large models require enormous amounts of high-speed memory, like HBM, which is exactly what Micron sells. TurboQuant changes the equation. It uses techniques like quantization and pruning to reduce the precision of calculations, sometimes down to 4-bit or even 2-bit, without significantly hurting accuracy. This can shrink memory requirements by 60 to 80%. It also uses something called sparsity mapping, which means the system only accesses a memory it actually needs for a given task, instead of constantly pulling from DRAM. So why is this scary for Micron investors? First, lower capacity requirements. A server that previously needed over a terabyte of memory might now only need a fraction of that. Second, longer hardware life cycles. Companies may delay upgrading to newer, more expensive memory like HBM4 if older systems become sufficient. Third, a shift from hardware to software. If performance improvements come from smarter algorithms instead of bigger memory stacks, it could put pressure on pricing. However, there is another side to this story. More efficient computing often leads to more usage. If TurboQuant makes AI cheaper and more accessible, It could drive a surge in applications, which would eventually increase total memory demand over time. Right now, the market is focused on the short-term risk of reduced demand. Now, let's compare Micron to its main competitors to see how it stacks up. There are three major players in the memory market: Micron, SK Hynix, and Samsung. In terms of valuation, Micron trades at around 11 to 12 times forward earnings. SK Hynix trades much lower, around 4.7 to 4.9 times, and Samsung sits around 7 times. So why does Micron trade at a premium? One reason is that it's the only major U.S.-listed pure-play memory company, making a preferred choice for U.S. funds and AI-focused investors. In terms of market share, SK Hynix is currently the leader in high-bandwidth memory, with over half the market. Micron is a fast follower, gaining share with more power-efficient designs. Samsung is making a comeback and aiming to capture a significant portion of the market by 2026. Looking at financial strength, SK Hynix currently leads in profitability. Samsung has the strongest balance sheet, with massive cash reserve and very low debt. Micron sits somewhere in the middle, with manageable debt but very high capital spending, around $25 billion per year. So what's the bottom line? If you're looking for the purest AI growth play, Micron offers strong upside potential, especially if the AI boom continues. But it comes with higher volatility and risk. If you want a cheaper valuation with strong current dominance, SK Hynix stands out. And if you prefer stability and resilience, Samsung is the most diversified option. So is Micron still a buy? Most analysts still say yes, but there are clear risks. TurboQuant could slow memory demand. Massive capital expenditures could become a burden if growth slows. And competition in the HBM space is intense. On the other hand, if you believe AI is still in its early innings, today's drop could be a classic buy-the-dip opportunity. Micron's HBM supply for 2026 is already fully sold out, which gives strong visibility into future revenue. One final thing to watch is margins. Micron recently reported gross margins of nearly 75%. If those levels hold, the company is a cash generator. Also keep an eye on the next earnings call. Management's response to TurboQuant will be critical. If they're not concerned, that could tell you a lot. As always, do your own research before making any investment decisions. Thank you for watching, and if you found this helpful, please like the video and subscribe to the channel. See you in the next one.